My name is Andrew Betwain. I'm the editor of InsuranceInvestor.com and FundOperator.com. And today I'm joined by Michael Ashton, who is the inflation guy on social media. And in his day job, he's the managing principal at Enduring Investments. Hello, Michael. How are you?
I'm doing great. Glad to be here.
Fantastic. Thank you for joining me. Michael will be speaking at our Institutional Fixed Income Investor Online Summit for North America 2022 on the 19th of October. Michael will be speaking on some very interesting topics, which I'm going to dive into in a minute. So the panel discussion we'll be speaking on is inflation, the Fed, and geopolitics, the prognosis for the global economy and the impact on fixed income. So really easy to digest conversation there, which will have no detail and be really easy for everyone to follow. So I'm going to start off with you, Michael, with hopefully a really easy question, which you're going to be able to answer for us. Can you discuss how the current multi-decade high in inflation will affect fixed income investments?
Sure. So let me understand that the purpose here is you're going to get me on record, and then in October, you're going to compare my answers then to these answers and see, okay, perfect,
Exactly.
perfect. It's interesting. We've had interest rates below sort of neutral interest rates for so long that the current sell-off in bonds just seems completely overwrought. But we used to believe when I first came up in the fixed income markets that a neutral nominal rate was something like the long run expected rate of inflation plus equilibrium real growth. And so in the United States, that would be something like 4.5% would be sort of a neutral 10-year nominal interest rate. And neutral real interest rates then would be something around 2%. Well, it has been a long, long time since we've gotten there, and we're not there yet. And so I guess my view is that unless inflation suddenly collapses back to what it was pre-COVID, that's probably where we're going to end up, and that's probably where we should end up, is something around 4.5% nominal and 2% real, and that's probably healthy.
So my next question is sort of following on from that, and is there any upsides? We're hearing inflation being described in these doomsday scenarios on both sides of the Atlantic. Is there any upsides around this inflation process we're going through in North America and or further afield?
Well, if you're the inflation guy, there's definitely an upside. I mean, it's I've been the inflation guy for a decade where nobody really cared about inflation. So for guys like me, it's certainly an upside. I think that there aren't a whole lot of upsides to inflation. What if at the end of this episode, two things have changed? I would say that we've made some improvements, and one of those things is a general deleveraging. When we have the nominal cost of money as low as we've had it, and the real cost of money being as low as we've had it, as low as it is right now, you tend to get much more leverage in the system, which tends to make the system more fragile and things break a lot. And that's in fact what we've seen over the last couple of decades. As interest rates have been very low, things go along swimmingly for a while and then they break. And so I think that if the higher inflation and higher interest rates leads people to be more cautious in how they take positions, how they lever, how much risk they assume, that would probably be good for the system as a whole. Historically speaking, we don't tend to learn those lessons for very long. We have a crack up and everyone swears off it. It's kind of like drinking. The next day you sort of swear off it. I'm never going to do that again. And a couple weeks go by and you find yourself, taking a tipple. So but that would be nice. And I think the other thing is if we, at the end of this, have a more nuanced respect or lack thereof for central banks and the power of what central banks really can and cannot do. And if the central banks themselves maybe lost a little bit of their overconfidence that they know exactly the dials to move and they can instantly change everything and get back to where we wanted it, I think that would be a positive thing as well. I think that there's a great deal of hubris in central banking circles, unwarranted hubris. The low inflationary environment had not a whole lot to do with central banking, and they took a lot of credit for it. And if at the end of this they are properly chastened, that would be a positive outcome as well. But other than that, kind of hard to find a lot of good in inflation.
Well, I've never heard inflation compared to functional alcoholism before, so that's a good sign. Wanted to build on that central banks topic you've just mentioned and sort of stay on the regulator and the sort of governmental bureaucratic side of it. So the Fed, how have you seen their reaction to this crisis? And depending on that, how would you like their approach to change or not change through the remainder of 2022?
It's fascinating to me that we are proceeding through this cycle, and what is really unprecedented monetary policy, and I'll explain that in a second. And we're acting as if this is kind of totally normal. But the Fed has never attempted to rein in inflation by moving only interest rates. They've never done that. In the entire history of the Federal Reserve, they have operated through, I mean, in the old days, it was done a little bit differently, but operated by changing pressure on reserves. And so interest rates would rise, but that was a symptom of what they were really doing, which is making money more dear and slowing the growth rate of money. In this current episode, there is copious liquidity, and the Fed is slowly reducing its balance sheet, but banks have so many excess reserves that they are not reserve constrained. And since they're not reserve constrained, it's not clear at all that you're going to get an appreciable and lasting slowdown in the growth rate of money. I mean, loan growth should proceed as long as certainly banks are more eager to lend at higher interest rates, and borrowers tend to be more interest rate inelastic in terms of how much they want to borrow. So, I guess the point being, this is entirely an experiment, and we're the Fed is walking through this, or they're running through this in a very aggressive way, as if they know exactly how this all works. And again, this goes back to the hubris. You should have zero confidence that you know exactly how this works, because at best you have a model that has never ever been tested. And my druthers would be for the Fed to A, be a little more cautious in what they're doing, but B, they shouldn't be focusing on the price of money. They should be focusing on the quantity of money. And so and by the way, this has no chance of changing. This has there's no chance that they're going to change policy in the way that I would suggest, and that would be to focus on reducing excess reserves aggressively and let interest rates do what interest rates do. That's what I would do. But again, it has no chance of that happening in 2022 or 2023, and maybe at the end of this crack up, if they sort of sit and reassess, maybe a little change. But if I was there, that's what I would be doing.
So we're just trying to completely change American fiscal policy there. So yeah, just a Thursday afternoon for us. Yeah. My final question before I let you get on is, where do you see us heading in 2023, and especially around let's say in a great world that the inflation rate has started to slow in its growth. Do you see the market conditions hint at that in these easing increases?
It'll be interesting in October to see where we are, because right now, as we sit here in mid-July, the inflation markets are pricing in that the inflation will almost immediately and dramatically go right back to the Fed's target over the next couple of months and stay there forever, which is amazingly cavalier. And in fact, if the Fed really looks at the inflation markets as being indicative of consumer inflation expectations, which I don't think it is, but they have in the past looked at break-evens, inflation break-evens and inflation swaps as being indicative of where consumer expectations are, then they shouldn't be tightening because, well, those expectations are extremely anchored right now. And that just strikes me as being, again, very optimistic. And I think that what's going to happen over the balance of 2022 is inflation is going to come down on base effects, although we've said that a number of times. And we're still seeing measures like median inflation, which are sort of a better measure of the breadth of inflation and price pressures. They haven't started slowing yet. But over the balance of this year, we're probably going to see those numbers come down. I still think we're going to be median inflation in the high 4s, low 5s, and at the end of 2022. And I think where I really differ from a lot of other prognosticators is I don't think that's going to be drastically lower in 2023. I think we've sort of broken the low inflation, stable at 2% model. And I think that this means that investors who haven't thought at all about hedging inflation for 25 years will need to. At the very least, we're going to have more volatility to inflation. Inflation vol has been 0 for a quarter century. And I think that changes an awful lot about the way you manage portfolios going forward. But I do think that going into 2023, we're going to have lower inflation, but we're going to continue to it's going to continue to surprise people that it's not going down as fast as they thought it was going to go down. And by the way, I will say one other thing, and that is that the reason that everybody believes that inflation will rapidly go back down is that all of the models that people use, that they've used for the last quarter century, have this survivorship bias. If you're using a model that you've trained on the last quarter century of inflation data, and it did not have a strong mean reversion coefficient, then you threw out the model. It didn't work for the last quarter century. And so all the models out there that are currently used assume that there's going to be a rapid reversion to the mean. And that sort of model's behaving badly. And I think that it's not going to work out the way those models think. We're not going to have the mean reversion that we've had in the past.
So in all of that, we should focus on the fact that people can come in October and join the webinar, and they can point and go j'accuse when inflation hasn't done exactly what you've said it might do. So if you found what Michael is saying is interesting, and I found it fascinating, thank you very much for your time, Michael. You can join us on the 19th of October at the Institutional Fixed Income Investor North America 2022 Online Summit, which we promise we won't say the whole name again. And Michael will be there discussing the Fed, geopolitics, and inflation. I'd like to thank him for his time today. And thank you very much for watching. And I'll see you at the webinar in October.